That is the charge, that the Federal Reserve is the only game in town. Well, it doesn't have to be the only game in town. There are other sources of policy which could also be affecting long-run interest rates.
Fed Vice Chair Stanley Fischer pointing the finger at Congress because, you know, they do monetary policy at the Fed. Congress does fiscal policy. He said those in charge of fiscal policy can actually move interest rates by making a few moves of their own and hence hopefully fix the economy. Fisher pointed to the fact this afternoon when he spoke at the Economic Club in New York that higher government spending, read stimulus, and lowering taxes could boost the natural rate, as he called it. Let's get right to the floor show, see what that really means. Traders at the New York Stock Exchange, CME Group and the NYMEX. John Corpina, I thought that was very interesting. In the past, we've heard Janet Yellen say, hey, we shouldn't be the only one trying to bail out this boat from the water that's in it. It's a pointed comment to Congress, is it not, to start doing something, maybe lowering taxes, maybe doing a spending program of some sort?
Liz, it is, but are you surprised? This is politics. A lot of finger pointing that occurs here. So everyone doesn't want to take responsibility, but they do want to take the acclaims when things do work right. The Fed has painted themselves into a corner where they've kept interest rates low for a very long, extended period of time, longer than they suggested they were going to, and now they're being forced to make a decision, and they're being forced to point the finger as to what other things can other people do and other, you know, our own government and other.
So you don't think that's fair, John? They have left rates extremely low for quite some time, many, many years. I mean, they raised last December by a measly 0.25%. So we're at 0.5% for Fed funds futures, Fed fund rates, which are the overnight rates that banks lend to each other. But, I mean, what else can they possibly do?
I don't think it's fair, because I think the Fed actually believes that they should have raised rates back in June, and they missed their opportunity when we had a lot of market fluctuation. And even 3 members of the FOMC believe that we should have raised rates then and at their last meeting. So that contradiction, that confliction that we keep hearing out of Washington and out of the Fed leads investors to be a little wary about what the landscape is going to look like moving forward.
Yeah, and you know, Scott Shellady, you could look at the 10-year yield. We started to see that rebound. Actually, the yields fell, but the 10-year price rebounded from 4-month lows. So to see this at 1.76%, I think it went as high as 1.81%. A lot of our viewers own treasuries. They've been too nervous to put their money in the stock market. So what does this mean looking ahead?
Well, I don't think the 10-year is really going to do a ton going forward. But I think that with what we saw today, I heard today from those comments, I think it kind of looked like to me they were giving up, or at least he was giving up, saying, hey, we can't do anymore, really. And if things go bad again, we don't have anything else to do. So he's kicking it back over to Congress, which I always thought was going to be a very difficult thing for them to do, number one. And number two, when is Congress going to do this? I mean, we've got an election last I checked, and whomever the new president is going to be isn't going to really get around to doing anything until sometime in the middle of next year. So we're stuck with this. And I think the problem here is, I agree with your last person, is that they've missed raising rates at the first hurdle for the last 3 years. Okay, so that's why they're having this problem now of no credibility. They've had a ton of other times where the economy's been a lot stronger than it is today, and they're talking about raising rates today, a lot stronger than it is today, that they've not done so. That's the problem. So now I think he's got his hands in the air, he's given up, pass it over to Congress and say, we've done what we can do.
Well, and let me just get to what we just showed on the screen. We showed the S&P laggards on a day like this with a lot of news flow from different sources. But, Luke, a lot of these names are energy names. Southwestern, Chesapeake, Endo, Devon, Cabot Oil and Gas. What a shock. Some numbers came out from OPEC members, and it appears that Libya has expanded its output. I just don't see OPEC making any move to find religion, cut output, and so therefore we're back below $50 a barrel.
Yeah, I'm going to do my Home Alone impression. Really? They expanded output?
Kevin.
Shocker. Well, I mean, Liz, you know, I'm gone for 3 weeks and the whole market turns upside down. For 18 months, I sit here and say nothing's going to change. But I will say this, as we've talked about on the show, I was around trying to gather information and putting on weight. But as we've said, you always brought up the points in the last year and a half. Why is OPEC doing this? Why are the Saudis doing this? They wanted to push out the marginal producers. The marginal producers are now out, right? And they've shown OPEC who the boss is. And now they're going to say, We want everyone to come in line, and we're going to set prices. But remember, as we said before again on the show, the break even for some of these marginal producers, oil has to stay above 50 to around 52.5 for a good 6 to 9 months. That's not going to happen. Right. So I think this 50, it wasn't able to break 50. I think it's going to stay below 50. And I think 47.5 might be the new magnet.
Okay.
But I don't, until the end of the election, I don't see it.
All right, a lot we have to wait for, or not, until the end of the election. Thanks to all of you. John Corpina, Scott Shellady, Luke Rahbari.